Welcome to it. Well, South Africa's fourth biggest bank by market value, Nedbank, reported its interim figures today, indicating a strong bounce back in the 6 months to June. And to give us more color into the 6 months that was and what they're expecting for the next few months ahead, we're joined by Michael Davies, who's the Chief Financial Officer at Nedbank. Michael, thank you so much for your time. Let's go through the 6 months that was for Nedbank.
Yeah, so thanks again for having me, and afternoon to all your viewers. We were certainly very pleased with the performance for the first 6 months of 2021, with headline earnings up 148%, largely being driven by strong growth in NII, albeit that our loans and advances portfolio declined slightly year on year or period on period. Pleasing growth in commission and fee income. Pleasing growth in insurance income and recovery, strong trading performance, but obviously off a very high base of 2020. And then the big outperformer is obviously in the credit loss ratio or the impairment charge, which essentially was down on the prior period by in excess of 4 billion rand. And that's largely being driven by higher levels of collections, a slightly smaller loans and advances portfolio, a better macroeconomic outlook. Certainly, if you look at the macroeconomic outlook and expectations of 2021, substantially better off a very low base of 2020, with an expectation of GDP growth of around 4.2% and interest rates flat for the balance of 2021. So certainly impairments and the impairment charge through the income statement significantly lower than the prior period. And then costs well contained. Obviously, the outperformance does come with slightly higher incentive costs, which drives the overall expenses growth to 6%.
Right. So a month ago, we were still dealing with the looting and the riots that affected parts of KZN and Gauteng. From a Nedbank perspective, what has been the impact on ATMs and branches as a result of those events?
Yeah, so the events were very saddening. They've had an adverse impact on not only our physical footprint at the time. We closed in excess of 50% of our branches and Boxer outlets over that period in those affected regions. And at that stage, 55 of our outlets were damaged as a result of the looting that took place in both regions. We currently have around 29 branches that are still closed as a result, and around 23 Boxer outlets still closed as a result. At the time, we also had roughly 8% of our ATMs that were vandalized, and that's cost us about just over 32 million rand in cash losses. So that was about 325 ATMs that were damaged as a result. And we had expected GDP growth in 2021 to recover to around 5%. The consequential impact of the events of the riots and looting has reduced that by 0.4%. So a devastating consequence.
Yeah. Let's talk about, the economy and your forecast for it, but also what it means for household and company credit demand.
Yeah, so obviously if we can grow the economy by 4.2% or higher in the upcoming period, obviously that does bode well for households, small businesses and corporates. We've certainly seen a lot of corporates looking to repay debt and essentially retain very cash flush positions as a result of concerns around the COVID-19 pandemic and more recently the looting and unrest. And we certainly need corporate South Africa to grow in order to stimulate high levels of economic growth in South Africa.
Right. There's so much that I would have wanted to discuss with you, but unfortunately we have a little bit of time. But I just wanted to gauge with you. We've been talking about the post-COVID world, and I'm not sure at this point what that looks like, given the fact that we still have the Delta variant spreading. From a, brick and mortar point of view for Nedbank staff, what does that work from home scenario look like right now? Is that going to be the case, or will that be adjusted slightly?
So the COVID-19 consequence of COVID-19 is simply accelerated something that we were busy or in progress in any event, and that was to migrate towards a more mobile type work environment where we would cater for smaller numbers of employees working at our campus sites, with more of our employees working from home on a mobile basis. And COVID simply accelerated that. So we're likely to end up in a position where roughly 60% of our staff work from a campus site at any given time, with around 40% of our staff working from home.
Right. All right, Michael, thank you so much for your time. That is Michael Davies, who's the Chief Financial Officer of Nedbank, taking us through the 6 months that was. However, as we shift gears a little bit and look at the markets picture, Asian markets happened to close mixed at this particular point, with the Chinese markets appearing muted. But when we look at what is happening on the side of the Hong Kong index, that managing to rise nearly 0.25% in this final hour of trade. And the muted performance seems to have flowed through as well in the European markets as we monitor the cautious developments on that particular front. Investors are looking at the spread of the COVID-19 Delta variant as well as key economic data that continues to flow through at this particular point. U.S. Equity futures at this point appearing flat and possibly an indication of a muted open on Wall Street a little bit later on. Locally, we had our business confidence figures coming in, and that managed to fall to a 9-month low, 93.2 from a 96.2 in June, and it's the lowest figure that we've seen since June last year. And part of that has to do with the events that we did see last month as a result of the unrest and looting that took place around KZN and Gauteng. But when we look at what's happening from a SENS point of view, we did get a trading statement from Advotech. So once those results come out in the next few weeks or so, we'll definitely have Advotech back on the show, because it'll be quite interesting to see how households are viewing the education space against this economy that we're currently finding ourselves in. But to talk to us about some of the themes playing out, we are joined by Michael Traherne, who is from Vestec Asset Management. Michael, thank you so much for your time. Take me through the JSE performance so far.
Yeah, afternoon, Nastasia. JSE slightly down this morning after opening in the green. We're currently down 0.13%. We're at 69,500 points, tantalizingly close to breaking 70,000 for the first time. We got close this morning, we got close yesterday, but we still haven't been able to break it. Will we break it tomorrow? Fingers crossed. It's always nice to hit these milestones. But at the moment, it looks like markets are mostly flat. I suspect CPI data out of the US later today will be quite a big driving force for global markets.
Right. Just before we came to you, we had Michael Davies, who's the Chief Financial Officer of Nedbank, taking us through the 6 months that was. But I'm curious, from an analyst point of view, what did you make of Nedbank's numbers?
I'd say the market was probably disappointed. The banking peers are in the green today, where Nedbank's down slightly. So that initially shows you that the market was a little bit disappointed with the numbers. I would say that it's in a very messy environment. It's tough to get a read. They're coming off a low base from last year. There's a very uncertain future going forward. But I think the two main things that you need to look at when you're analyzing the banks is first, have management declared a dividend, because that shows you the confidence of future cash flows. And Nedbank has now reinstated the dividend, joining most of the other banks. Them and ABSA were the two in the last round not to declare dividends. So that's always very, very positive. And then the second thing is a massive reduction in debt provisions. And that shows Nedbank's confidence that bad debts aren't going to be anywhere near as bad as they had forecast last year this time. And they're bringing that money back into the business. And that's why you're seeing their profits up 150%.
You touched on the fact that later on we are expecting US CPI data. What are market expectations? And also, what will it mean if the CPI numbers come in higher than expected?
So the market's expecting CPI to be roughly what it was last month this time, on the high end of what the Fed likes. But the US Fed, which is their central bank, is forecasting that inflation is temporary. So they're seeing a short-term spike due to bottlenecks and then a relaxation in inflation. There are parts of the market that think that inflation is going to keep getting hotter and go higher. So if we see that inflation comes in higher than the previous month, that shows that things are looking a bit hotter than expected. And it will put pressure on the Fed to raise interest rates sooner than expected. And a raise in interest rates means lower share prices, essentially, because debt gets more expensive. So interest rates very, very closely correlated with share prices, where too high interest rates is a bad thing. Or I should say too high inflation rates is a bad thing, leading to high interest rates. We'll be paying close attention this afternoon to their CPI number.
The impact of the Delta variant then continues to spread on oil demand at this point.
Yes, so it's Delta's a bit difficult to pin down because it's hitting different countries at different stages. If we had this conversation on Monday, it would be oil was down heavily because China looks like it's locking down due to the spread of Delta. A lockdown China means less consumption of oil, which means lower oil prices. But yesterday afternoon, the US showed increased demand for oil prices, and the economy looks to be opening up, and they seem to have recovered from a recent wave. So oil's actually higher today, but it shows you how volatile things are and the uncertainty about what's happening going forward. And that's before we've even considered the impact of OPEC and their supply restrictions. So oil looking volatile, but as a consumer, I'll take low oil any day of the week.
All right, Michael, thank you so much for your time. And as Michael mentioned, those US CPI numbers that we are expecting later today. Tomorrow, we are expecting the OPEC monthly oil report, and that will give us some kind of indication in terms of where OPEC is seeing things when it comes to releasing, the oil taps at this particular point. And then we also have US consumer sentiment that is out on Friday. So all of that we will be monitoring for you. That is it from me, and thank you so much to my guest, Michael Traherne from Vestec Asset Management.